Everyone thought they knew exactly what they were signing up for when they bought SCHD. Safe income, steady dividends, boring but reliable performance, something you could buy, forget about, and let the cash roll in. That was the deal. That was the promise. But today, SCHD looks very different from what most investors expected, and that gap between expectation and reality is exactly what we need to talk about right now. When SCHD first became popular, it wasn't flashy. It didn't promise explosive growth or overnight riches. It promised discipline. It promised quality companies, strong balance sheets, and consistent dividend growth. Investors flocked to it because it felt predictable in a world that was becoming anything but predictable. For retirees, long-term income investors, and conservative portfolios, SCHD felt like a no-brainer. But fast forward to today, and many holders are quietly asking the same question. What did I actually sign up for? Over the past few years, SCHD has faced challenges that most investors didn't fully anticipate. Rising interest rates changed the entire dividend landscape. Suddenly, safer yields were available in places that didn't exist before, like high-yield savings accounts, money market funds, and short-term treasuries. That alone shifted the math for income investors. When risk-free options start paying competitive yields, dividend ETFs have to fight harder to justify their place. At the same time, SCHD's price performance hasn't lived up to the expectations that many newer investors had. A lot of people bought SCHD not just for income, but with the hope of steady capital appreciation alongside it. Instead, they watched the price stall, drop, or move sideways while growth stocks captured all the attention and headlines. This is where frustration began to build. Many investors didn't realize that SCHD is designed first and foremost as an income vehicle, not a growth engine. Its selection process focuses on dividend sustainability, cash flow strength, and balance sheet quality. That means it naturally avoids many high-growth tech names that dominate market rallies. When growth stocks surge, SCHD can feel slow, outdated, or even broken. But that doesn't mean it stopped doing its job. What really surprised people was the emotional side of holding SCHD during a tough market environment. Dividend cuts, slower dividend growth, and sector concentration started to stand out more. Financials, industrials, consumer staples, and energy play a large role in SCHD's composition. When these sectors struggle or face cyclical pressure, SCHD feels that pain directly. Some investors expected SCHD to be immune to volatility. That was never realistic. Even high-quality dividend stocks are still stocks. They react to economic cycles, interest rate changes, and earnings pressure. The difference is that SCHD tends to absorb stress differently. Instead of dramatic crashes followed by explosive rebounds, it often grinds through long periods of underperformance that test patience. And patience is something many investors didn't know they lacked until now. Another part nobody signed up for was the changing narrative around dividends themselves. For years, dividends were seen as a sign of strength and discipline. Lately, the market has rewarded reinvestment, innovation, and aggressive growth instead. Companies that pay large dividends are sometimes viewed as having fewer growth opportunities, even when that isn't entirely true. This shift in mindset has real consequences. Valuations compress. Investor enthusiasm fades. Media coverage disappears. Suddenly, holding SCHD feels lonely, especially when social media is full of screenshots showing massive gains in speculative stocks. But here's the uncomfortable truth. SCHD was never meant to be exciting. It was meant to be reliable. The problem is that many investors bought it for the wrong reasons. They wanted safety and growth. They wanted income and upside. They wanted something that could compete with growth stocks while also paying them regularly. That version of SCHD doesn't exist. What exists instead is a disciplined, rules-based ETF that does exactly what it says it will do, even when that outcome feels disappointing in the short term. Now let's talk about the dividend itself, because this is where emotions run high. When SCHD's dividend growth slowed, some investors panicked. They assumed something was broken. But dividend growth is not linear. It depends on corporate earnings, payout ratios, and economic conditions. During periods of uncertainty, companies prioritize stability over increases. In many cases, slower dividend growth is a sign of prudence, not weakness. SCHD's methodology filters out companies with unsustainable payouts. That means when conditions get tough, SCHD is less likely to chase yield and more likely to protect the long-term income stream. That protection often comes at the cost of short-term excitement. And yes, that's frustrating. Another thing nobody signed up for was how long income strategies can underperform growth strategies. These cycles can last years, not months. If you bought SCHD expecting quick validation, the market has likely humbled you by now. Income investing rewards discipline over decades, not quarters. This is where the real divide among SCHD investors appears. Those who understand what they own tend to stay calm. Those who don't feel betrayed. If you're holding SCHD today, the question isn't whether it's good or bad. The question is whether it still fits your strategy. If your goal is consistent income with lower volatility than the broader market, SCHD may still be doing exactly what you need. If your goal is beating the S&P 500 every year, it was never the right tool. That distinction matters more now than ever. Let's also address the idea that SCHD is somehow outdated. Some critics argue that dividend-focused ETFs can't keep up in a world driven by technology and innovation. But that assumes innovation and dividends are mutually exclusive. Many dividend-paying companies are deeply embedded in the global economy, generating massive cash flows that support both stability and growth. They just don't move fast, and they don't make headlines. In a market obsessed with speed, slow feels broken. But slow can also be durable. Another uncomfortable reality is that SCHD exposes investor psychology in a way few ETFs do. When markets are euphoric, SCHD feels boring. When markets are fearful, SCHD suddenly feels smart. That emotional swing causes people to buy high and sell low, even with a product designed to reduce that behavior. Ironically, the biggest risk to SCHD investors isn't the ETF itself. It's impatience. So what is the SCHD nobody signed up for? It's an ETF that forces you to confront your true investing personality. It asks whether you value income over excitement, discipline over speculation, and long-term consistency over short-term validation. For some, that realization leads to selling. And that's okay. Not every investment is right for every investor. For others, it leads to a deeper understanding of why SCHD belongs in their portfolio, especially during times when confidence is scarce and noise is loud. SCHD isn't broken. It isn't flashy. It isn't perfect. It's exactly what it has always been, just viewed through a harsher lens. If you're holding SCHD today and feeling disappointed, that feeling says more about expectations than execution. Markets change. Narratives shift. Strategies rotate in and out of favor. Income investing has always been a long game played quietly in the background. And eventually, when the cycle turns, quiet strategies tend to speak the loudest. The SCHD nobody signed up for is slower, more patient, and less exciting than people imagined. But for the right investor, that version may be the one that matters most in the end.